make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Well, today, another Fed day, the conclusion of a two-day Federal Open Market Committee meeting. Normally, I do this podcast at 8 a.m. on Eastern, but I'm doing it almost an hour early because Game 5 of the World Series starts at 8 o'clock. And so I was hoping to kind of put my podcast in before that game starts. Although if the Blue Jays win again tonight, maybe Donald Trump is going to have to hit the Blue Jays with an emergency 100% reciprocal tariff because he's going to have to protect the American team from that foreign competition. So, you know, the Dodgers have 3 Japanese pitchers in their starting rotation. So I don't know. I mean, how does Trump feel about that? Maybe have to have a tariff on baseball teams import foreign players. I don't know. Maybe I don't know how many. Maybe there's more Americans playing for the Blue Jays because they don't need Japanese players, as far as I can tell, on their roster. It's just the Dodgers that have all the Japanese players. Anyway, I'm just kidding, but we'll be watching that game myself after I finish this podcast. But anyway, so getting back to the news of the day. So the Federal Reserve, as expected, interest rates by another 25 basis points. So the Fed funds rate now has a target of 3 3/4 to 4. All right. Now, the official inflation rate is about 3%, which would leave real interest rates, assuming that you believe the official inflation numbers, which I don't, but it would leave real interest rates at about 1%. And for people who pay taxes on their interest, it's even less than that. Of course, I think the actual rate of inflation is far higher than what the government admits. And so as far as I'm concerned, interest rates are negative. They were negative before the cut, and they're even more negative after the cut. Now, also, as expected, the Federal Reserve announced the official end to its quantitative tightening program, QT. That's going to end in December. And last I checked, the balance sheet is about $6.7 trillion right now. Now, if you remember, before the 2008 financial crisis, it was below $1 trillion. I don't remember the exact number, but it was less than $1 trillion. And it blew up pretty big. So by the end of QE3, before they started to shrink the balance sheet, it peaked out at about $4 trillion. But early on, I think it was in 2009, when Ben Bernanke first went to Congress to testify about the QE program, and somebody asked him, and I can't recall the name and either whether it was a senator or a representative, but somebody correctly pointed out to Ben Bernanke that the Fed was monetizing government debt like a banana republic. And he was concerned, and rightly so, with the Fed, monetizing government debt. And Ben Bernanke was very emphatic in his denial that the Fed was monetizing debt. And his explanation as to why the Federal Reserve buying government bonds was not monetization was he said that in banana republics, when the central banks buy government bonds, they keep them. But in contrast, he said that the Fed was just temporarily buying these bonds, that it was just because there was an emergency, a financial crisis, so the Fed was going to temporarily expand its balance sheet, buy these bonds. But then when the emergency was over, it was going to sell the bonds back into the market. So in other words, there would not be a permanent expansion of the Fed's balance sheet. And for that reason, we were not monetizing the debt like banana republics. And so America was not a banana republic. Well, at the time, I said BS. I said, yes, Ben Bernanke can claim that it's temporary, but I think it's permanent. Back then, I said there's no way that the Fed is going to reverse this, that this is a monetary roach motel. The Fed checked in, and it ain't never checking out. Well, here we are now in 2025, and the balance sheet is $6.7 trillion, and the Fed says we're not making it any smaller, which proves that Ben Bernanke lied or just was completely incompetent if he actually believed what he was saying. I at least was smart enough to know that what he was saying was impossible. But at least somebody should officially come out and say, okay, we are monetizing debt. That's what the Fed did. That's what it continues to do. And so we are no better than a banana republic. We are, in fact, a banana republic. The only difference between America and a banana republic is the bananas, right? We don't got them. And now, if we want to buy them, of course, we got to pay tariffs on them as we import them. But that's a significant development, that there's an end to quantitative tightening. I'm surprised it took them so long. I actually thought they would have ended it a while ago. In fact, I thought they would have gone back to quantitative easing by now. Now, I believe that that's coming. We'll probably get that next year. And I think stopping quantitative tightening is just the first step to initiating quantitative easing. Also, what the Fed mentioned is that to the extent that bonds mature, they will continue to roll over the principal. But if it is a mortgage-backed security that matures, the Fed won't roll that over into more mortgage-backed securities. It will roll it into treasuries. And so this, instead of helping the housing market, a lot of people thought that, hey, if we stop quantitative tightening, it's going to really help the mortgage market because the Fed won't be selling mortgage-backed securities. Well, they're not going to be buying them either. They're not going to be rolling over. So the mortgage-backed securities on the Fed's balance sheet is going to continue to contract despite the fact that quantitative tightening is over. So it's not really over for the mortgage market, only for the Treasury market. And so I think you're going to start to see rising mortgage rates, not falling mortgage rates. And in fact, one of the things that happened today in the market as a reaction is bonds got clobbered and yields on the 10-year to the 30-year shot up as a result of the rate cut, which is, again, something that I had been forecasting. And I think that you're going to continue to get more increases between now and the December meeting. So I think that rates will be higher when the Fed meets again in December than they were in November when they cut. And so they're lowering short-term rates, but long-term rates are not cooperating. They are going up. But I think the most significant thing about today's announcement was Jerome Powell stating on multiple occasions and really going out of his way to state this. So it wasn't just in the Q&A, although he repeated it in the Q&A, but it was in the prepared remarks. And Powell said that monetary policy is not on a preset path and that December is kind of up in the air, that it is not a foregone conclusion that there will be another rate cut. In fact, he went out of his way to say it is far from a foregone conclusion that we're going to cut rates again. Now, before today's announcement, a December cut was virtually a lock. And so now the odds have gone down considerably, although it's still favored. Now, it's a bit surprising that the markets didn't react even more negatively to Powell basically rug pulling a December rate cut when the markets are pretty much banking on that. So I think maybe a lot of people believe that we're still going to get a cut in December. I would put myself in that camp. I think the Fed maybe just wants to pretend that there's going to be a lot more thought going into the next decision, but that we're probably going to get the cut anyway, because there is a lot of political pressure behind the scenes for the Fed to cut rates. And I think the Fed knows that the economy is a lot weaker than it lets on in public. So I think we're going to get a cut, but there is now some more uncertainty, which, should be weighing on an overvalued market. The stock market hit new highs again today. The NASDAQ, in fact, the NASDAQ was, I think, the only index that managed to close positive today. And so another record high. The other indexes were all down, but they weren't down dramatically. Maybe the Russell 2000 was probably the weakest of the bunch. But it could have been a lot worse, given that this was a hawkish cut, right? To the extent that you could cut rates and be a hawk, right? Although, there's nothing hawkish really about anybody on the Fed anymore. Even the hawks are doves. But there could have been a bigger sell-off than there was. The other significant event of this announcement was there were two dissents. Now, you got one, right, who wanted 50 basis points, right? That's Stephen Moran. That's Trump's guy, his yes man that he just slipped in to the Fed. And, of course, he's voting for 50 basis points, right? He's just doing what Trump wants. But, Trump, is in Japan. And, he was, bragging about how great the economy was in Japan, right? We got the hottest economy in the world. We've got the strongest economy in the world. We got the strongest economy in U.S. history. And, of course, he credits all that strength with his own policies, right? So because of Donald Trump, we've got the hottest economy, the strongest economy, yet at the same time, he claims we need these massive rate cuts, right? Obviously, those are inconsistent. If the economy is so great, why does the Fed need to slash interest rates, especially when inflation is as high as it is and going up? So I think, the fact that Trump really believes that we need all this support shows you that he knows the economy is not strong, right? Even he doesn't believe his own BS about the U.S. economy. But his guy, Stephen Moran, is in there, and so he's voting for 50 basis points. But there was another guy, I think he was the head of the St. Louis Fed. I forget the guy's name. But he voted for no change, right? Not a hike, right? Which is, I think we should be hiking rates. But at least you had a guy that said, don't cut them. So you had most of the members that said, let's cut rates. You got one guy that says, don't cut them at all. And you got one guy that says, cut them more. But obviously, a lot of divisiveness at the Fed, right? You've got, different opinions, which I think is rare. Normally everything is unanimous, right? And that's not the case now. But in any event, I'm going to get over some of the more significant things that were said in the Q&A. Again, interestingly, Powell still puts a very positive spin on the situation. We're in a great place. The economy is doing great. Near 2% growth. We're at full employment, right? Of course, this is all BS because of the way we measure employment now, right? If we measured unemployment the way we used to, we would be nowhere near full employment. So we don't actually have full employment. We're just pretending that we have it. But the Fed is also pretending, right? The Fed should look beyond those numbers, but no, it wants to perpetuate the government propaganda that we have low unemployment and that we have good economic growth, which again, we don't have because the GDP numbers that purport to show that growth are also inaccurate because they dramatically understate inflation. And of course, the last thing that Powell wants to do is call into question the inflation numbers because he hides behind those numbers to try to claim that, we're getting close to 2%, even though he admitted, right, that inflation was 2.8, right? And he admitted that even the core year over year, if you take out food and energy, he admitted that was 2.8. Now, he also tried some more sleight of hand later on when he talked about tariffs, and I'll get to that. But he said if you exclude the impact from tariffs, he said, tariff inflation. And again, there's no such thing as tariff inflation. There are tariffs and there are inflation. They're different things. But he said if you exclude the impact of tariffs, he said, hey, we're even closer to 2%. We're 2.4-ish. All right, well, even if that's the case, 2.4 ain't 2, right? It's 40 basis points above 2. What's that, 20% or something like that? That's a big number. What if inflation were 1.6 right now, right? Oh, they'd be slashing rates. They'd be doing QE. They'd be saying this is terrible. We're 40 basis points below target. This is, we can't have this. We need more inflation, right? But when they're 40 basis points above it, but we're not even 40 basis points above it. There, you have to strip out what you claim is the effect of tariffs, because if you leave the tariffs in, it's 2.8%. But again, one thing that Powell said is that, look, once these tariffs work their way through the system, we don't have to worry about them anymore because it's just going to be a one-time increase in prices, and it's not necessarily going to repeat. And so we don't have to worry about it if it's only a one-off event. We're worried about a continuous increase in prices. But I'm going to get a little bit more into that because he clarified and made some interesting comments in the Q&A. But before I even get into that, and we're going to take a quick commercial break, but before I get into what was discussed, I want to talk about the one thing that wasn't discussed at all, that never came up once, and which should have come up, and that's the price of gold. $4,000 gold, the fact that gold had shot up so much between FOMC meetings should have been brought up, but wasn't. And I'll discuss that right after this break, so stick around. As a business owner, I know the challenge of navigating unpredictable markets, interest rates, and inflation. That's why having the right tools are essential. NetSuite streamlines operations and scales with growth. Over 43,000 businesses have already future-proofed their businesses with NetSuite by Oracle. It's the #1 AI ERP. NetSuite brings accounting, financial management, inventory, and HR into one fluid platform with one unified business management suite. There's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecast, you're peering into the future with actionable data. When you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. Whether your company is earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. NetSuite is the platform that I would choose, and you should too. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/gold. The guide is free to you at netsuite.com/gold. All right. So speaking about gold, right? Gold was completely MIA at the Federal Open Market Committee meeting. Now, considering the fact that gold is the main monetary asset, central banks now have more gold than U.S. Treasuries, foreign central banks. You would think that the rise in the price of gold would at least have deserved a question. I think it should have been front and center. I mean, the Fed should have to address that elephant in the room. But no, the topic was never even discussed. And I've mentioned on my podcast that Alan Greenspan, who people call him the maestro, and he's still held in high regard, including by, a lot of members of the Trump administration who speak about him. He specifically said that gold was his barometer of whether or not he got interest rates correct. That even though we weren't on an official gold standard, unofficially we were, because Alan Greenspan still looked towards the price of gold as a market indicator of whether or not rates were too high or too low. And so what he told Congress was $400 gold meant he was too loose, and $300 gold meant he was too tight. And so he was kind of eyeing for around 350. And so if the price of gold stayed around 350, that would indicate to him that he had got interest rates about correct. Well, if $400 gold meant that Greenspan was too loose, what does $4,000 gold mean now? What is that saying about the Powell policy? Clearly, if 400 was represented too loose money back in the 80s, well, then 4,000 certainly must represent the same thing now. And so that's why it should have been brought up. And by the way, my last podcast, I titled it Gold Test $4,000 Support. And some people might think, well, obviously it failed the test because now we're below 4,000, which is the case. We did end up falling below it this week. And in fact, gold closed below 400 today, although it did trade above 4,030 this morning. But it closed below it. As I'm speaking, we're up about $20, but we're still just below 39.50. But also on my last podcast, when I talked about 4,000 support, I did say that it was very likely that gold would go below 4,000 and that 4,000 could be support even if the market was to go below, because I think it's going to be similar to the way we handled the 3,000 support. It wasn't like 3,000 was some line that we couldn't cross. And the same thing with 4,000. We get below it. But whenever you get below it, you are in a support zone. And just like the market never fell too far below 3,000, I don't expect it to fall too far below 4,000, nor do I expect it to stay below 4,000 for any long period of time, because that would give too many people the opportunity to buy it below 4,000. And I don't think that's going to be the case. So I still think that we're at 4,000 support, even if we're trading at 3,950. I mean, we're close enough to 4,000 to say this is where the support is. Obviously, the resistance now is closer to 4,500 because we did get up to, I think, 4,400, because we got up to like 4,380. So we didn't quite trade 4,400, and then we had the pullback. But even with the pullback, where the price of gold is today is considerably higher than it was the last time the Fed cut rates. And the fact that the Fed is cutting rates and the gold price is going up is not a coincidence. Gold is reacting to a Fed that should not be cutting rates. Rates are too low, and the Fed is making them lower. And so the rate cuts are a mistake, and gold is clearly signaling that it's a mistake. Yet none of these journalists who are invited to ask, Powell questions understand enough about money or economics to ask the question or to point out that gold is flashing a warning, or they don't understand the warnings themselves, right? Because, they have to flunk a test on economics before they could be a journalist, an economics reporter at a lot of these newspapers or television networks. And then, then they get to ask these questions to Jerome Powell. But before I get back to discussing what Powell spoke about today and the market reaction, I want to mention one more thing about gold. And that is a new product at Schiff Gold that has been up on the website for a little bit, but I haven't mentioned it because I wanted to make sure we got all the bugs out of it. And I'm going to talk a lot more about it on Friday when I do the Schiff Gold market wrap. But I want to mention it again today so people know about it. But if you go to the Schiff Gold website, and on the top bar, you'll see it has gold, silver deals, and then it says trade. And if you click on trade, it'll take you to a page on the website that'll eventually be a direct link right now to my URL T-Gold. But T-Gold will take you to this trade page. And on trade, you can open up an account, you can click on it, and you can buy gold and silver, not for delivery. So we're not going to ship you coins and bars. Not that I don't think you should still buy coins and bars and take custody. You should. But this is an alternative where you can buy in increments, small increments, and Schiff Gold will store your metal for you in a third-party vault. But you can buy as little as, $100 worth of gold or silver. You can buy $50 worth, right? You can just buy little bits at a time, and you're buying very close to spot because you're buying small pieces of a large bar. You're not buying individual small bars or coins where you have to pay a higher premium to pay to fabricate those smaller denominations. So it's a very cost-effective way to buy gold and have it stored. But what I'm going to be doing here, and this is why I want to make sure that everybody, who listens to this podcast, when you're done, go to Schiff Gold and open up an account, open up a trade account. Now, eventually we're going to have an app where you could just download it in the App Store and have it on your phone. Right now, you got to do it, on a desktop computer, but eventually you'll be able to do it on your phone. But for now, you can go to your computer on the Schiff Gold website and open an account. It'll only take you a few minutes to get this account opened up, and then buy yourself some gold. Now, you can't use a credit card yet. That's coming. But you can pay for it, direct deposit, ACH, so it's simple to fund it. And what I'm ultimately going to be doing is building out a ecosystem where gold can serve as a medium of exchange. So what I'm going to be doing is introducing debit and credit cards that will be linked to these accounts. So the debit card will allow you to spend gold if you want to in real time, where you can go to any merchant and use the debit card, or you can go to ATM machine and pull out cash, and it will, sell some of your gold automatically. Also, a credit card. If you don't want to sell your gold, but you want to borrow against it, you'll be able to use a secure credit card that will have a very low rate of interest because the loan is collateralized by your gold. Then you just have to pay off the loan, right? Like you're paying off your credit card, and now you won't pay interest anymore. But the interest will be a lot lower than it would be if you borrowed it on a normal credit card, because I'm not taking much risk because I got your gold. I've got excellent collateral to loan off of. So you'll be able to borrow against your gold, and you'll be able to spend it. But what I also want to do, and I'm going to be working on this, I'm building this up, is allow anybody who has an account at Schiff Gold, who has gold, will be able to transfer, send, or receive gold from any other account holder. So if you've got some gold with Schiff Gold, and a friend of yours has an account, and you owe them money or they owe you money, you could pay each other directly in gold. Ultimately, I want to sign up merchants to have accounts with Schiff Gold that advertise that they accept payments in gold because they want to be paid in gold. And so then instead of using your debit card, which will convert your gold to dollars, you could just pay directly in gold. So the merchant will receive gold from you. And of course, if you're a merchant yourself, right, if you're a Peter Schiff Show listener and you've got a business and you want to be paid in gold, then you can establish an account with Schiff Gold and allow your customers who also have accounts with Schiff Gold to pay you in gold. Now, also one of the things I'm going to be working on for all you crypto fans is I will be doing a token, whether it's my own token or whether I'll partner up. I have a lot of people that want to partner up with me, but I will be introducing a gold-backed token, which of course is the same concept as a stable coin, right? What is a stable coin? Well, you have a third party that holds US dollars, and that third party that holds dollars issues these stable coins like Tether, right? And then you hold that. Well, if you can issue a token backed by dollars, why not issue a token backed by gold? And that way, at least you have real stability, because there's nothing stable about the dollar. So if you have a token that's tied to the dollar, it's just going to lose value over time. Whereas if you have a token that's tied to gold, it will preserve its value over time. That's real stability, not fake stability. So I think to the extent that you like stable coins, you should love a gold-backed stable coin, tokenized gold. And in fact, I mentioned this on a podcast I was on, and CZ from Binance heard that, and he said, that's BS. That's trust me, bro. Nobody's going to want a gold-backed token because you have to trust somebody, which of course you have to trust people to hold your dollars, right? So if you're going to trash gold-backed coins, you got to trash the entire stablecoin industry. But I am probably going to be doing a debate with CZ, and I may even be going to his conference in Dubai. I got to iron out those details, but that would be in early December. I probably won't have my token launched by then. I mean, it's on the list of things to do, but it's not the highest priority. The first thing was getting the infrastructure set up, which is here now. So the key today is to get as many people as possible to go to Schiff Gold and buy some gold and to keep it on this platform. Now, once it's there, you could trade it. I'm not encouraging people to buy and sell, but you could sell the gold and hold the cash in your account, and then you can buy the gold back later, or you can withdraw the cash. But the transaction costs are going to be low. But the idea is just to buy the gold and hold it, and maybe or eventually to use it as a medium of exchange. So the physical gold and silver that we're selling at Schiff Gold, that's for you to keep as a store of value. But the gold that I'm encouraging you to buy through this trade platform is the gold that I want you to be able to use as a medium of exchange, as an alternative to the dollar, right? To use gold the way it's meant to be used, as money, but using modern technology to make it much easier to use gold as money than it's ever been in the past. And gold worked great as money in the past. It's going to work even better in the future. And by the way, on Bitcoin is back down to about 110,000, right? So it's still about 12% below its US dollar high from, was it August that it hit that high? Bitcoin didn't make a new high when gold made new highs. And when gold corrected, it didn't make a new high. In fact, it barely rallied. People were saying, there's going to be a big rotation out of gold into Bitcoin. Yeah, the rotation lasted one day, and then it ended, and now Bitcoin lost whatever it gained. But Bitcoin also stopped making new highs with the NASDAQ. The NASDAQ has made a new high just about every day. Yet Bitcoin doesn't do that. So Bitcoin's not going up with risk assets. It's not going up with risk off assets. It's just drifting down. But if we get a bigger correction in the NASDAQ, which we obviously could have at any moment, or a big rise in gold, because Bitcoin is negatively correlated with gold and positively correlated with the NASDAQ. But I think we're setting ourselves up for a big drop in Bitcoin. So it'd be a great time for you Bitcoiners to go cash out your Bitcoin and get some of the gold on my new platform. And then you'll be able to use your gold in ways that you could never use your Bitcoin. It'll actually work. It'll actually solve the problems that Bitcoiners pretend Bitcoin can solve, but that it can't. And, when it comes to Bitcoin, too, I've never seen a consensus trade where there was more faith that you couldn't lose. There's so much conviction in Bitcoin, Not only do they think they can't lose, but they're guaranteed a huge gain. Bitcoin's not just going to go up. It's going to 10x. It's going to 100x for sure. You can't lose. And, you've got the president behind you. You got Wall Street behind you. I mean, you've got everything going right for Bitcoin. Nobody is negative. When you get a market like that, it really can only go in one direction because everybody already owns it. Since it's so obvious Bitcoin can only go up, then why would anybody not own it? Why would the people be waiting to buy it? They just buy it now. So everybody is already in. And so the question is, who's left to get in? Nobody. Well, what happens when people want to get out and there's no new money coming in? The bottom drops out. That's where we're headed. Gold is nowhere near that. I noticed I was watching CNBC. They had Jeff Gundlach interview, and he's been bullish on gold, and I'll give him credit for being bullish on gold. And now he's not as bullish because he was 25% gold before. Now he's saying 10% because he thinks it's too high. Well, I think it's already pulled back. But 10% is fine allocation because he said another 5% in base metals. And then he still recommends foreign stocks, emerging markets. So overall, it's still a good idea. But he shouldn't be less bullish on gold just because more people have decided to join in, because it's still the tip of the iceberg. It's still very early. And even though more people are bullish on gold, hardly anybody owns it. Now, yeah, people own gold in their jewelry. People own gold in their cell phone or stuff like that, but they don't own it as an investment. I would say more Americans bought Bitcoin as an investment over the last year by far than who bought gold. So Bitcoin's the crowded trade, not gold. If you own gold, you're still alone. Right? It's pretty lonely out there. There's a few more people who are stepping up. But the crowded trade and the consensus trade is in Bitcoin, and that's going to blow up. Anyway, let me just get back to the FOMC meeting, because while there were no questions about gold, there was a lot of discussion about the stock market and AI and tech stocks. Some of the reporters were asking Powell, are you concerned about the valuations in tech stocks? And do you think it's related to your monetary policy, right? I mean, and he basically said no. He said he doesn't think that interest rates are affecting AI stock prices, which I think is ridiculous. I mean, obviously, cheap money is fueling the mania, and without it, you wouldn't have the fuel. I mean, he said they don't really care about 25 basis points, which may be true, but in the scheme of things, rates should be a lot higher. And the fact that they're a lot lower than they should be is a big factor. In fact, one of the reasons that you can afford to make all these capital investments is because the cost of capital is low. If the cost was much higher, then they wouldn't be doing it. And ironically, a lot of these investments are being made to replace labor. So the Fed is making it cheaper to automate and to eliminate workers in favor of machines. Maybe if interest rates reflected a true market level, that we wouldn't be doing as much of this yet. Maybe we'd rely more on humans. In fact, two companies this week, UPS and Amazon, announced major layoffs. I mean, tens of thousands of people being laid off. And I think it's mainly because they don't need them anymore, right? Because they are using AI a lot more. But Powell didn't seem to care. He was asked if he thought that the stock market was too high or if he was worried about overvaluation. And he said, well, we really don't pay much attention or care about any individual price, which, of course, he wasn't asked about an individual stock price. He was asked about the entire market, right? The market, the stock market being overvalued is a big deal. It's not like one isolated price. It's this huge market, right, that has major implications for the economy if the market were to tank, right? But to say that, well, it's just one price, so who cares? He goes, we pay more attention to the totality of the market and of the economy rather, and the credit system, without recognizing how intertwined the stock market is, especially considering that today NVIDIA not only hit a new all-time record high, NVIDIA now has a market cap of over $5 trillion. $5 trillion. You know, to put that into perspective, there are only 3 countries in the world that have a total stock market capitalization. That means all the publicly traded stocks in the entire country. There's only 3 countries where the whole stock market is worth $5 trillion. The United States and China. And the third one is Japan. But Japan is only worth $5.4 trillion. NVIDIA could be worth more than Japan by next week, right? This is an amazing statistic, but it's also a very scary statistic. I mean, the whole U.S. stock market capitalization, I think NVIDIA is about 10% of the whole U.S. stock market is one stock. And of course, a lot of other stocks in the AI space, right? In the Mag 7, right? You have such a huge percent of the entire capitalization of the U.S. stock market just in a handful of stocks. This should be very concerning for Powell, but he's dismissing it. He said, hey, it's not like the 1990 dot-com bubble, because he said at least today, companies, they actually have a business plan. Yeah, I mean, they had business plans. They didn't have earnings, but just having earnings doesn't mean that it's not a bubble if you're trading at ridiculous multiples to those earnings, or if your earnings are being driven by vendor financing, where the companies are loaning money to their customers so their customers can keep buying their products and they get rewarded with a rising stock price, right? There's so much stuff. You know, Powell has got his head in the sand to deny that there's a stock market bubble. Yeah, AI is real. So is the internet, right? That doesn't mean you can't have a bubble, right? If it walks like a bubble, if it walks like a duck and quacks like a duck, it's a duck, right? Only the Federal Reserve could look at a duck and not think it's a duck, right? But that's what's going on. But they didn't want to discuss gold, but they at least discussed the tech stocks. You know, by the way, you know, Donald Trump talks about how these tariffs are great for American workers, right? We need these tariffs to protect American workers, right? Well, all workers are also consumers, right? So the workers that Trump wants to protect are also consumers. So they are also harmed by rising prices. But if you just forget about that, if you assume that maybe the tariffs will help them get a bigger raise, so that will more than offset higher costs. In America, we have about 12 million people that work in manufacturing. 12 million. That's out of a total population of workers of over 163 million. So about 7.5% of the U.S. workforce is in manufacturing. So at most, that's who's going to benefit from the protectionist tariffs. In theory, of course, in reality, they won't all benefit. A lot of them won't. A lot of them will lose their jobs because they're going to work at companies that will be less efficient as a result of these tariffs. But even if you assume that all 7.3 million got a raise because of tariffs, right? Because their employers were able to raise their prices because they had less foreign competition. And because they were able to raise their prices, they were able to pay their workers higher wages, right? So you have a small number of workers who benefit, but only because their employers can raise their prices on a huge number of workers, right? 92.5% of the workers who aren't getting a raise, but are getting higher prices on all the stuff that they're going to buy. And in fact, you can see that if you look at the biggest employers, because I was, looking at, Amazon laying people off. They're the second biggest employer in the country. Amazon. Number 1 is Walmart. But if you look at the top 10 employers in America, 8 out of 10 are retailers. They're stores. 8 out of 10. Those are our biggest employers, retailers. And the other 2 companies in the top 10 are FedEx and UPS, right? And UPS, again, laying off a bunch of workers. So you've got retailers, and then you've got the companies that deliver the stuff that the retailers sell. But the problem is, where is all the stuff that the retailers sell? Where's it all made? That is the problem. It ain't made here. We are a gigantic distribution center for foreign produced goods. If you look at the top 10 employers in Japan, where the president is, 8 out of 10 are manufacturers. That's where the stuff is being made. It's not just pictures that are coming out of Japan, right? They're manufacturing all sorts of stuff. Country like Germany, 6 of the top 10 employers in Germany are manufacturing companies. We don't have a single one in the top 10. See, that's why the tariffs aren't going to work. We don't even have the industries to protect. Right? They're just going to make what's left of our industries less competitive. But this shows you, right? And the Fed, Powell is talking about how great everything is. We're in such a great place because the Fed has done such a great job of micromanaging the economy with interest rates and making sure that we have full employment and stable prices. This is all a bunch of BS. On the Fed's watch, our entire industrial economy has disintegrated, and we've outsourced all of these manufacturing jobs, and we've replaced them with these service sector jobs. And we have this gigantic credit bubble, and Powell is completely clueless about any of this. Right? We're not even close to being in a good place. Now let me look at a few other things that they spoke about. Oh, this I thought was really rich. So Powell admitted, because he was asked, why are the people still upset about inflation? Because you claim inflation's come way down, but people are still upset. And Powell says, yeah, they are upset, and they have a right to be upset, right? He said the reason they're upset is because even though inflation has come down, prices have not. And he admitted that prices today are a lot higher than they were a few years ago. And that is why people are so upset, because the high prices haven't come down. In fact, they're still going up, right? So if prices were too high and now they're going up, even if they're going up a little, you're still making a bad situation worse. Now, I agree with what Powell said. Yes, the problem is prices went way up and they never came down. But whose fault is that, right? Why doesn't Powell, or why doesn't somebody ask Powell, okay, then why are you targeting 2% inflation? If you admit that prices came way up and they never came down, why don't you target falling prices, right? Why can't the Fed pursue policies to bring prices back down? Because that's what the public wants. Why can't they get it? Because remember, right, when inflation had been too low, according to the Fed, right, it was below 2% for a few years. The Fed said, oh, no, we need to average this up, right? Inflation's been too low. We've been below 2%. We need to average it up to 2%. So we need to run monetary policy a little hot because we need to make up for all the years where inflation was lower than 2%. Well, if you admit that people are pissed because prices are so high and inflation was way above 2% for so long, why, based on the same rationale, why is the Fed not targeting inflation way below 2% to average all that high inflation back down and to deliver actual relief to the American consumer who he claims he cares so much about, right? Oh, we're here to help the consumer with price stability. Okay, well, that means we need lower prices. We don't need prices to go up by 2% a year. We need prices to come down. And in fact, they need to come down by a lot more than 2% a year because they went up by a lot more than 2% a year, right? If prices went up by 6, 7, 8% in a few years, why can't they come down by the same amount, right? I think people would be very happy, would be very relieved if they had that kind of price decline. But no, that's completely off the table because as far as the Fed is concerned, it doesn't matter how high prices go up. They always have to keep going up, right? So if we have 1 year where prices go up by 50% in 1 year, the Fed wants to make sure that next year they go up another 2%. So you're at 52% and then 54%, right? We can't have prices go up 50% and then go down by 10%. Oh no, that'd be a disaster. We can't allow that. This is what Powell is saying. That's why it's not that, this 2.5%, 3% inflation. You have to look at it in the context of all the inflation that preceded it. We do need lower prices. We need much higher interest rates to bring the price level back down. Instead, what Powell wants is he said it's going to take a while. We need wages to catch up to prices, right? And that way people can afford. So in other words, he wants more inflation so that people can get higher wages to afford the higher prices that resulted from the inflation of the past. But of course, the policies that he is pursuing to increase wages will also increase prices. So it's going to be like a dog trying to catch his own tail. It's never going to happen. In fact, Powell said that the reason they want to cut rates, right? Because he said we're in a good place, but we're in a challenging place. The good place is we got all this economic growth, we got full employment, but he said the risk is to the upside to inflation and to the downside to employment. And therefore, we're kind of, in a difficult spot because, if we want to fight inflation, we got to hike rates. If we want to fight unemployment, we got to cut rates. We obviously can't do both at the same time. We got to pick one. And so this is a difficult position because we're not really sure, which road to go down, right? But when he was explaining it, he said that the reason that they're able to stimulate employment by cutting rates is he said that rate cuts stimulate demand. And by stimulating demand, we create jobs. And that's not true. I mean, maybe that's what the Fed thinks, but you don't create jobs just by stimulating demand. You actually create jobs by stimulating supply. And supply is actually curtailed by these rate cuts because rate cuts encourage more consumption, but only to the extent that you borrow the money, right? Because lowering interest rates just makes it cheaper for you to go out and borrow money and buy stuff. But borrowing money and spending it doesn't grow the economy. It does push up prices, right? So you get higher prices when the Fed makes it easy for people to go out and borrow money and buy stuff. But what really grows the economy and creates real employment is the production of stuff. And by artificially lowering interest rates, the Fed actually discourages production. What we need is higher interest rates so that we have more savings to finance more capital investment, to finance more production. So we make more things. And it's the supply that ultimately creates real demand. And that's where we get good jobs. We don't get good jobs by expanding credit, right? That's what the Fed wants to do, is expand credit. Well, that's create inflation. I've already described that inflation is not just an expansion of supply of money, it's an expansion of supply of credit. And Powell thinks you stimulate employment by expanding credit. You don't stimulate employment by creating inflation. You stifle it. I mean, the only way that you help create jobs by creating inflation is because you lower the minimum wage, right? Because the government sets an artificial minimum wage that makes a certain group of people illegal to employ. Well, as inflation erodes away the minimum wage, it's like reducing the minimum wage. And when you reduce the minimum wage, you do get an increase in demand for unskilled workers. So you do help people overcome the minimum wage by creating inflation. but nobody wants to fess up to that, right? They don't want to say, hey, we like inflation because it gets to reduce the minimum wage and now people can get jobs. They like to pretend, and the Fed likes to pretend, that it can create jobs by creating inflation. It can't. And it doesn't want to label the credit expansion inflation, but that's exactly what it is. So anyway, this was more BS today from the Fed. I expect gold to continue to rise based on the back of these continuous string of policy mistakes by the Fed that, is now in a trap of its own design, and it can't escape. And so the result is ultimately going to be a dollar crisis and a sovereign debt crisis. The people who think that you can ignore gold's rally because the bond market isn't collapsing, the dollar's not collapsing against other fiat currencies, that's all wishful thinking. All this stuff is going to happen. The fact of the matter is people are losing confidence in all fiat currencies, not just the dollar. But at some point soon, you're going to see the dollar losing a lot of ground relative to its fiat counterparts. But of course, if you wait for a dollar crisis, if you wait for a bond crisis to protect yourself, you've waited too long. By then, it's far too late to do anything. Right now, you still have the opportunity to protect yourself. You still can buy gold and silver. You can still move money out of U.S. stocks, into foreign stocks, into emerging markets. You know what had great day today is the base metals, right? The industrial metals hitting 52-week highs today. A lot of those stocks we own in our strategies. I own a lot of them personally, but these stocks, copper and other metals, just on fire. I'm still waiting for the energy. Energy stocks had a decent day today, but oil's still hanging out around $60 a barrel. There's a lot of people that are bearish on the price of oil. I am not one of them. I am expecting a big move up at some point in oil, and so there's a lot of opportunity in energy. So make sure and visit the Euro-Pacific website, europac.com. Talk to my advisors about getting an account set up, a separately managed account, or get into my mutual funds. You can learn about my mutual funds on the website. You can buy them no load at any discount broker. And don't forget to sign up for the newsletter at schiffsovereign.com. And again, don't forget to subscribe to the Schiff Gold YouTube channel and look out for Friday's Schiff Gold Market Wrap that I will be recording on Friday after the close. For now, enjoy Game 5 of the World Series. I'm going to go check it out myself right now. Bye for now.